Let's talk more about it with one investor who's buying into the large cap story to a point. He is David Dahl, President and CEO of Cantley Trust. David, joining us from Houston, thank you very much. And David, listen, recently in the last couple of months, large cap names have started to slowly outperform. But I got to tell you, I've been anchoring the show for a while now, long enough to hear people pronouncing small cap stocks dead for 4 and 5 years, and it has not happened yet. Will it this year?
Well, Brian, it's good to be back with you. We think that large cap stocks are ideally poised at this point of the economic cycle. A couple big reasons for that. We see, as you've just pointed out, we see great leverage moving forward in a slowing economy, a real chance to expand relative to their small cap and mid cap brethren from an earnings perspective. And then more importantly, they have fantastic cash on their balance sheets, cash that they turn around to shareholders in the terms of share buybacks, dividends. With $1.5 trillion that we estimate on the S&P 500, that's cash that can be ideally used for the benefit of shareholders, and that really poises them for upside coming forward.
And by the way, it is a new 52-week high for the S&P 500 today, by the way. A lot of people may have missed that with all the deal news out there. So new 52-week high. But you have to believe, David, in the earnings story. I mean, you have to think we're again going to hit double-digit earnings growth for the next couple of quarters in order to believe that it justifies the move we're seeing.
Well, we're close. We're very close, as a matter of fact. Coming up 4.5 years now with unbelievable earnings growth. I mean, we've talked with clients about it's feeling like we're on a freeway going 85 miles per hour, having to slow down to 65. And at 65, you're still going pretty well, but you feel like you're crawling. 70 years, 7.5%, that's where earnings grow at. And we've been at double digits, almost twice that for 4 years. We think that this quarter we're going to be real close to it, maybe around 9%. We don't think that folks give enough credit to the economy and the underpinnings that sit there at this point.
And I'll tell you what group is soaring again rather quietly. I did a special on it last week. The OSX, oil services companies, all 15 in the OSX are higher for the year. And as you've said to me in the past, and I've read some of your notes anyways, get close to the wellhead when you look for investments. What does that mean?
Well, Brian, that's an excellent memory. We started talking about that last year. We really see reserve replenishment, production figures being the key, making a concentrated decision to move away from some of the big integrated oil companies, specifically a company like Hess that we've talked about in the past, even with it up 15% year to date. Here's a wildcat play if there ever was one. Somewhere around 18 or 19 billion in a market cap exposure, a little bit underappreciated. We like how this company is positioned and its results when it goes looking for oil.
All right, what else here? Looking at in my notes, discretionary consumer. I kind of had to do a double take, David. I see that my singer producers are saying you like Tiffany, and I thought, well, if the economy slows, won't these be the first companies to go? Or do you buy the story that, you know, listen, some people are going to be so wealthy it doesn't really matter, and they're going to shop at these stores regardless of how the economy goes?
Yeah, Brian, it's the latter, not the former. We again think that the economy is given a little bit less credit than it should at this point. We see stability. We don't see recession. I mean, heck, it was just 4 or 5 weeks ago we were talking about when was the Fed going to cut to spur things along, and now we've got such blowout numbers on unemployment, final sales coming through GDP. We think that the high-end consumer is not impacted at all by the subprime market. We see a company like Tiffany and some of the other high-end providers in that space being really well positioned to continue as the economy is stable.
Can you go to any of the sort of the more expensive or higher socioeconomic discretionary names like a Coach or maybe some others, or is it just Tiffany specific?
Well, for us, we focused in on Tiffany. We like their international exposure. One of our themes here for our clients in the last few years has obviously been beefing up the international side of things. And with Tiffany's strong presence, especially in Asia, that plays out perfectly for us. It gives us the double bang of the high-end consumer, where we've got resiliency against the market, and then the international theme where we can pay attention, as we've talked about before, for growth rates around the world accelerating while the U.S. is declining just a bit.
I'll tell you one of the most quietly interesting stories in the stock market. It is a company you like, is Altel AT. The stock, David, isn't or has not moved since December of last year. That's the far right of the screen that we're showing our viewers right now. The interesting thing, of course, is about a month ago, it basically put itself up for sale with a strategic review. So either one of two things is happening. Either people don't believe there'll be a premium paid to the price, or people have simply forgotten that it's up for sale.
Well, there's a couple things at play here. A little bit longer chart would show you that this stock has been on a steady upward trend through December, about $48 to $60 a share. We sit today around 62. The stock is about flat since the first of the year, as you point out. The issue here is that Alltel is kind of in a wait-and-see period right now, as they don't need to make a quick move. Whether it's Verizon or Sprint, two very high-end players that are going to be looking at them. Most likely Verizon as the landscape plays out. We don't see Alltel being in play quickly right now, but they have certainly put themselves there. And let's not forget for a second that private equity, this is a company that's $22 billion in market cap. Private equity isn't going to let something get away from them without a real close look, because the net free cash flow that is predictable here now that the wireless has been spun off is a very attractive feature with this company.
All right, David Dahl, Cantley Trust CEO. David, thank you very much.
Brian, my pleasure.